Okay. What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to do some stock analysis for SoFi stock. My friend Akash said he was buying this stock in the last couple of days. So I want to do some stock analysis to see if this is a good buy. In the last 5 years, this stock has been everywhere from $4 to $30 a share, very volatile. And if we take a look at their numbers here, we can see that revenue has been very strong, very consistent. Last couple of years, they're growing almost 30% per year. They just did $4.7 billion for the past year. Keep in mind, this is a $22 billion company, so it's a price to sales of 4.6. Not too bad. Then we look at the growing number of members, also growing about 34% in the last couple of years, up to over 13 million members now. So that's also very nice. They're growing their products about the same, 35%. EBITDA is up. Net income is, at least it's profitable now because it was negative for a long time. So net income's at 480 million for last year, which is pretty good. But they're not growing net income super fast, and free cash flow is also shrinking. So those are the only problems. But that could just mean whatever. They have a lot of accounts receivable, or they're investing heavily back into the business. There's a couple different things. They are a pretty fast growing business right now. So you just got to keep that in mind. Then we go down to the cash to debt. Definitely got a whole lot better this past quarter. They're up to 5 billion in cash, a little under 2 billion in debt. But it probably is, I mean, that comes with a side effect, and that is the shares outstanding have gone up 17% in the last year, which is kind of insane. That's a really big number. But that's probably where they raised a lot of their cash from, and that's why we see that cash to debt so much higher now. But again, you can look at it like they're doing that for a good reason. They're going to invest back into the business. It could be a positive catalyst, but they're also diluting shareholders. That's definitely not helping out the stock price. So not you can look at it like hopefully they stop diluting shareholders if they have enough cash and if they're profitable, which they are profitable. Maybe they just need more money, but I mean, and free cash flow has been shrinking. So you have to look at these different things, like why are they doing it and what's going to happen in the future. Then we go down to the valuation, which is very important. In the last 2 years here, we're looking at a PE that's at about 45 times earnings, which is not cheap, especially for a company that is they're growing sales, but they're not growing earnings or cash flow at all. So keep that in mind. But it has been about the same valuation for the last year and a half now, or yeah, almost about a year. For the past year, it's been about 40 times earnings. So you're not getting a great deal, but you're not really overpaying that much either. Free cash flow yield is negative for some reason, even though they have positive free cash flow. Price to sales, it's the same thing. It's not super cheap, but it's not super expensive. It's come down a lot from the highs. It's also not at a price to sales of 2 like it was 2 years ago. So just keep that in mind. And price to sales is there's I mean, like they're growing sales. Like that's not the problem. So you kind of have to acknowledge that even with that sales growth, their sales are higher, but that valuation you're paying is also higher, because I mean, if I could get this at, let's say, 2 times sales, that's a big difference, right? That's a big deal if we were paying what $10 billion. If we're paying $10 billion, that's like half the stock price right now. So that'd be a whole different story. But the important thing here I want to get into, so we can look at what analysts had them doing: $0.4 EPS last year, then 0.6, then 0.8. So pretty nice growth there for earnings. Just keep in mind what you're paying for that. Revenue between 20 to 30%, pretty good. And then we have a short summary I wanted to point out by Claude here. SoFi holds a strong number 2 or number 3 position among U.S. neobanks by membership, but differentiates itself through its bank charter, diversified product suite, and business-to-business technology platform. More of a full-stack financial institution than a pure neobank, which is very important because that is a pretty significant differentiator compared to a lot of other fintech companies out there. But we go over here to Gemini. Lots of important things to point out here. I asked Gemini about SoFi's moat, and pretty much through its subsidiaries Galileo and Technisys, if that's how you say it, SoFi owns the plumbing of modern banking. Now, this is something that's actually important, that actually sets them apart from just your average fintech or bank stock. Most fintechs rent their technology from third parties, and SoFi owns the tech stack. In 2026, this segment provides a high margin recurring SaaS revenue stream that is decoupled from interest rates or credit risk. Phenomenal there. When a competitor like a new neobank or a large brand like MasterCard wants to launch a card or banking product, they often have to pay SoFi for the privilege of using the platform. I like that more than anything else. That's my favorite revenue stream they have as of right now. Unlike most fintechs like Chime, SoFi is a federally chartered bank. This allows them to do $37.5 billion in customer deposits to fund its own, or to use its 37 billion in customer deposits to fund its own loan. Also a plus. The cost advantage. Renting money from other banks costs roughly 6 to 7%, and because SoFi has its own charter, they use customer deposits, blah blah blah, only cost them 4%. This massive spread allows them to be more profitable than any other fintech that doesn't own a bank. So super nice advantage there. SoFi's zero cost marketing engine. This is also great. Traditional banks spend huge sums to acquire a customer for each separate product. SoFi acquires you once, often through a low cost tool like SoFi Relay, which is credit monitoring, or a high yield savings account. Oh, and personally, I don't use SoFi, but I did download it years ago, probably just for that high yield savings account. And I wanted to test out their stock market investing interface, but I'm not really a SoFi user. That's one of the things holding me back from buying the stock is I see a whole lot of competition, and I do see a nice moat for SoFi, so I understand if you are bullish on this, but I see a whole lot of competition, and I use Chase Bank, right? So why would I go to SoFi for something if I can go to Chase? And then there's just so many different platforms. There's Robinhood does this, and Square does this. There's all these different platforms. Once you're in the app, it costs SoFi nearly $0 to convince you to take out a loan or start an investment. 2026, 40% of all new products are opened by existing members, a cross buy rate that is almost double the industry average. That's another very impressive metric, so they do have a lot of nice things going for them. The average SoFi borrower this year has a 740 plus FICO score and a six-figure income. That's also nice because during economic downturns, high income professionals are the last to default, and this prime credit focus protects SoFi's balance sheet from the subprime volatility. So that is the main thing. Now, Gemini says the only real crack in the moat here is regulatory risk. SoFi is now a real bank, and the Muddy Waters report argues that their moat is actually just clever accounting. I looked into that a little bit. I'm not buying that too much. I mean, those reports definitely will hurt the sentiment on the stock, but I don't know. I mean, SoFi is trying to sue them for defamation and stuff now. So I don't know if I fully buy into how accurate that is. I mean, you really have to know like how are they categorizing stuff on the balance sheet and all the detail. You almost have to be an insider in the company to really know the truth about that stuff. So it's hard to tell. But am I going to invest in this right now? Like I said, no, probably not. It is in a very sharp downturn though. So if this stock were to go to somewhere near these levels where it's like $8 or $9, then it might be more interesting. But you know, like I said, there's lots of competition. They have a strong moat. And if you're bullish on this, I can understand why. It's just probably not a stock for me at the moment. But let me know what your guys' thoughts is down below, and I will see you in the next video.